Bajaj Finance, Trent, Eicher Motors. You've definitely heard these names. Today, they're some of India's biggest wealth creators. But a decade ago, they were mid-cap companies. Take Bajaj Finance. Back in 2013, it was a relatively small player, roughly a 7,000 crore company. Today, it's crossed 5 lakh crores. The stock went from about 13 rupees to over 1100 rupees. So if you had invested 10,000 rupees back then, it would be worth more than 8 lakh rupees today. That's close to 40% annual returns. And this isn't a one-off story. In fact, many of today's large-cap giants were once mid-caps, or many of today's mid-caps could become tomorrow's large-caps. And that's exactly what makes mid-caps so interesting. They sit in a sweet spot. As per SEBI, these are companies ranked 101 to 250 by market capitalization. Big enough to be stable, but still small enough to grow meaningfully from here. Let's look at some data to know how mid-caps have performed at the index level over time. If you look closely, mid-caps haven't just beaten large caps, they've done it by a wide margin. And over long periods, even a small edge like this can completely change your final wealth. But as we all know, markets don't move in a straight line. In 2025 and early 2026, global markets saw some correction. Tariffs, geopolitical tensions, and the US-Israel-Iran conflict have created uncertainty. And India hasn't been untouched either. As of March 2026, the Nifty Midcap 150 index is down nearly 11% from its recent peak. Which means while midcaps can create wealth, they can also come with sharp corrections along the way. Whether it's phases like this or bigger events like COVID or the Russia-Ukraine war in 2022. That's why it becomes critical to back the right companies, the ones that can not just grow fast but also survive and recover across cycles. For most investors, identifying the next Bajaj Finance or Trent among hundreds of mid-cap companies is extremely difficult. In large caps, most companies are already well covered. There's a lot of information available and it's difficult to find something the market hasn't already priced in. But in mid-caps, it's very different. Many good companies are still under-researched and not widely tracked. They quietly grow without attracting much attention from the broader market. And that's where fund managers come in. A good fund manager can make a real difference by spotting these companies early. Their ability to research, select, and build portfolios is what can make mid-cap funds more resilient and smoother through volatility. They are often more consistent than index and can even beat the mid-cap index in terms of returns. However, even here, not all funds can deliver the same results. If you look at 5-year rolling returns, out of 24 funds, only 14 mid-cap funds actually beat the category average and 15 performed better than the Nifty Mid-Cap 150. And if you pay a little more attention, you will notice that the difference in returns between the top fund and the lowest performing fund in the category is nearly 6%. At first glance, this may not seem like a big gap, but over a 20 to 30-year investment period, this difference can have a huge impact on your final returns. So in mid-caps, it's not just about investing in the category, it's about choosing the right fund within the category. So how do you decide which fund deserves a place in your portfolio? One of the biggest mistakes investors make is judging a fund only by its recent returns. Short-term performance can be driven by temporary factors and doesn't always reflect how a fund performs across different market conditions. That's why at PowerUp Money, we don't rank funds based on just recent returns. Instead, we evaluate them across complete market cycles, looking at how well the fund protects capital during market declines, how consistent its returns are over time, and whether the fund manager follows a disciplined investment strategy. To make this evaluation structured, every fund in this video is given a score out of 100 based on 3 parameters: consistency, volatility, and recency. A higher score means stronger performance on that parameter, while a lower score indicates weaker performance. On top of this, we analyzed qualitative factors like the fund manager's track record, portfolio concentration, and sector allocation and investment style. To understand this evaluation framework in more detail, we have explained it step by step in a separate video. You can click here to watch it. Now, without further delay, let's look at the top 3 mid-cap funds for this market. Number 3, WhiteOak Capital Mid-Cap Fund. A 3-year-old equity fund launched on 7 September 2022, mainly managed by Ramesh Mantri, who brings over 20 years of equity investing experience and has managed the fund since inception. As of February 2026, the fund manages an AUM of over 4,000 crores and more than 2,000 crores has flowed into the fund in the last 1 year. Let's look at the fund's investment strategy. The fund follows a highly diversified strategy, investing in around 138 stocks, highest among the top 3 mid-cap funds. And to manage risk, no single stock has more than 5% allocation. Another interesting part of this fund is its OpCo-FinCo framework, which means before selecting any company for its portfolio, the analyst team looks at a company in two ways. First, they check how strong the business is and how much it can grow. Then they look at the financial side to see if the stock price actually makes sense. This helps them avoid paying too much and focus on strong companies. This fund invests most of its portfolio in mid-cap companies, showing strong conviction in the segment. A small portion goes into large caps for stability, while some exposure to small caps helps capture additional opportunities. And at the sector level too, the portfolio remains well diversified, instead of concentrating heavily in just one or two industries. Let's look at the fund's performance and scores. Since the fund is relatively new, so its track record is shorter. But its 1-year rolling returns and 3-year annualized returns beat the category average, giving it a consistency score of 86 out of 100. As we have already seen, the recent performance has been strong. The fund outperformed both the benchmark and the category average, earning a recency score of 93 out of 100. As mentioned earlier, the fund has higher exposure to mid and small caps, so volatility is expected. But diversification across 138 stocks helps manage risk, giving it a volatility score of 82 out of 100. At number 2, we have the Invesco India Mid Cap Fund, which was launched in April 2007. It is currently managed by Aditya Khemani, who has around 19 years of experience in equities and has been managing this fund since November 2023. Prior to joining Invesco, he was associated with major fund houses like Motilal, HSBC, SBI, ICICI and Morgan Stanley. The fund now manages an AUM of over 10,000 crore rupees. Before Aditya Khemani took charge, the fund was not among the top performing funds in the category. However, since late 2023, its performance has improved significantly, with stronger returns driven by a refreshed strategy and disciplined stock selection under his leadership. Let's look at the fund's investment strategy in the last few years. Aditya Khemani has made some tactical changes to the portfolio, like number 1. They're actively looking for newer and emerging businesses rather than established ones. For example, in healthcare, it focuses on hospitals and CDMOs, not traditional pharma companies. And in consumption, it is betting on fast-growing segments like quick commerce with companies like Swiggy and Eternal instead of regular retail chains. Number 2, also taken some clear sectoral calls, like it keeps lower exposure to IT and higher exposure to healthcare to add defensive balance. Number 3, to manage risk. The fund avoids putting too much money in one company and keeps each stock selection exposure around 5%. Number 4, another interesting shift happened recently. 2 years ago, the top 10 stocks were just about 25% of the portfolio. Today, that number is close to 40%, which tells the fund is putting more focus on its strongest ideas. Number 5, coming to the allocation part, this simply means how the fund spreads its investments across different types of companies. In this case, the fund puts most of its capital in mid-cap companies that are still expanding, while keeping some exposure to large caps for stability and liquidity, and a small portion in small caps to capture emerging opportunities. We have also had a detailed conversation with Aditya Khemani about his strategy in a separate podcast. You can click right here to watch the full episode. Let's look at the fund's performance and scores. As you can see, the fund has beaten both its category average and benchmark across 1, 3 and 5 years. A revamped portfolio and tighter risk management helped drive this performance, giving it a consistency score of 83 out of 100. Its recent performance has been strong, and the returns in the last 1 year bring the recency score to 91 out of 100. Despite its strong mid and small cap exposure and concentrated portfolio of 47 stocks, the fund has kept risk under control, and that discipline shows up in the volatility score of 73 out of 100. Finally, at number 1 on our list is HDFC Mid Cap Fund. This is one of the oldest and most established mid-cap funds in India. Launched in January 2013, the fund has been managed by Chirag Setalvad since inception, along with Dhruv Muchal, who joined as co-manager in June 2023. As of Feb 2026, the fund manages an AUM of over 94,000 crores. Let's look at the fund's investment strategy. To keep a balanced approach, the fund invests in growth sectors like banking, auto and industrials, while also holding defensive sectors like pharma and insurance for stability. Since it's a mid-cap fund, the focus is on high-quality mid-cap companies for growth. But it also takes selective exposure to emerging businesses like Delivery, PB Fintech and Eternal. Coming to allocation, the fund's current portfolio as on March 2026 is nearly invested 69% in mid-caps for growth, about 9% in large caps for stability and protection against volatility, and close to 22% in small caps for extra upside during rallies. These allocations keep changing based on market conditions and the fund manager's strategy. The fund manages risk by spreading its portfolio across 79 stocks and invests less than 5% in any single company. So one stock can't significantly impact the overall portfolio. Now let's move to your favorite part, fund performance. Based on rolling returns, the fund has consistently outperformed both its category average and benchmark across 1, 3 and 5 years, giving it a consistency score of 87 out of 100. Strong performance over the last 1 year has pushed the recency score to 82 out of 100. The fund largely invests in mid and small cap companies, but good diversification and disciplined risk management gives it a volatility score of 69 out of 100. So finally, we come to the big question, which fund should you pick? See, the decision depends on your risk appetite and investment goals, but here's a simple way to look at it. If you prefer a well-established fund with a strong track record and experienced fund manager, then HDFC Mid Cap could be a good choice. It has delivered an SIP XIRR of 19.52% since inception. And over the long run, it has also outperformed its benchmark, which delivers 17.65%. But if you prefer a more focused and concentrated portfolio strategy, then Invesco India Mid Cap Fund could suit you. It has delivered SIP XIRR of around 19.27% since inception, and it has also outperformed its benchmark over the long run. And if you're interested in exploring relatively new funds managed by experienced fund managers, then WhiteOak Capital Mid Cap Fund could be worth considering. Launched in September 2022, it has delivered around 33% rolling returns in the last 1 year. If you're looking for other categories, we've also covered the top flexi cap and small cap funds for 2026. You can click here to check out those videos. For deeper insights across categories like large cap, mid cap and hybrid funds, you can explore the PowerUp Money app, a SEBI-registered RIA where our team of experts reviews and rates mutual funds every month. And don't forget to subscribe to the channel for more insights on mutual funds and investing.